The financial markets breathed a sigh of relief as President Trump announced a 90-day pause on new tariffs. This decision, a marked shift from the administration's previous stance, sent shockwaves through Wall Street and beyond. The S&P 500, a key indicator of market health, surged over 9% in a single day. This dramatic uptick, the largest since 2008, signaled renewed optimism among investors. The announcement followed weeks of escalating trade tensions and fears of a global economic slowdown. The markets had been on edge, bracing for the impact of a protracted trade war. Uncertainty loomed large, casting a shadow over businesses and consumers alike. The tariff pause, however temporary, offered a glimmer of hope. It suggested a willingness to negotiate and find common ground. This newfound optimism rippled through the markets, driving up stock prices and bolstering confidence. The surge in the S&P 500 was particularly noteworthy, reflecting renewed faith in the American economy. This index, comprising 500 large companies listed on stock exchanges in the United States, is widely considered a bellwether for the overall market. Its sharp rise indicated that investors believed the worst of the trade war might be behind us. However, the temporary nature of the tariff pause injected a note of caution. The market's euphoric response underscored the high stakes of the trade dispute. It highlighted the interconnectedness of the global economy and the potential for disruption. The 90-day pause, while welcomed, served as a stark reminder of the fragility of the current situation. It remained to be seen whether this reprieve would pave the way for a lasting resolution. While the market celebrated the tariff pause, a closer look at the details reveals a more nuanced picture. The pause applies to a wide range of countries, offering them a temporary reprieve from escalating tariffs. These countries will now face a baseline tariff rate of 10%, a significant reduction from the previously threatened levels. This move aims to ease the pressure on businesses operating in these countries and to encourage continued trade. However, the pause notably excludes China, a key player in the ongoing trade dispute. This strategic omission reflects the Trump administration's continued pressure on China to address its trade practices. The tariffs on Chinese goods remain at their elevated levels, a stark reminder of the unresolved issues at the heart of the trade war. This targeted approach underscores the administration's determination to secure concessions from China. The decision to exclude China from the tariff pause has significant implications for both countries. For China, it means continued pressure on its economy and businesses. The tariffs on Chinese goods make them more expensive for American consumers, potentially impacting demand. This could lead to job losses in China and a slowdown in economic growth. For the United States, the continued tariffs on Chinese goods could fuel inflation and raise prices for consumers. The exclusion of China from the tariff pause highlights the complexity of the trade dispute. It underscores the challenges in finding a solution that addresses the concerns of all parties involved. The ongoing negotiations and strategic maneuvering reflect the high stakes involved and the potential for both cooperation and conflict in the global economy. Despite the recent pause on tariffs for many countries, China remains firmly in the crosshairs of the Trump administration's trade policy. The tariffs on Chinese goods, now at a staggering 125%, continue to bite, impacting a wide range of industries and consumer products. From smartphones and laptops to video game consoles and toys, the tariffs are driving up prices and disrupting supply chains. The impact on American consumers is becoming increasingly evident. The cost of everyday goods, many of which are sourced from China, is steadily rising. This is putting a strain on household budgets and forcing consumers to make difficult choices. The tariffs are also creating uncertainty for businesses, making it challenging to plan for the future. The Trump administration argues that the tariffs are necessary to pressure China into making concessions on trade practices deemed unfair. They point to China's massive trade surplus with the United States, its alleged intellectual property theft, and its forced technology transfer policies as justification for the tariffs. However, critics argue that the tariffs are counterproductive, hurting American businesses and consumers more than they hurt China. The ongoing trade war with China is having a ripple effect throughout the global economy. Businesses are scrambling to adjust their supply chains, seeking alternative sources for goods and materials. The uncertainty is fueling volatility in the financial markets and raising concerns about a potential global recession. Section 4. Unintended Consequences: How Tariffs Inadvertently Benefit China. While the Trump administration's tariffs were intended to pressure China into changing its trade practices, they have also had some unintended consequences. Ironically, the tariffs have, in some cases, made China an even more attractive option for certain companies. This unforeseen outcome stems from the tariffs imposed on alternative manufacturing hubs such as Vietnam, Thailand, and India. With tariffs as high as 46% on goods from Vietnam, 36% on Thailand, and 27% on India, companies find themselves in a bind. These tariffs erode the cost advantage that these countries once offered as alternatives to China. As a result, some companies are hesitant to uproot their established supply chains in China, despite the ongoing trade tensions. The instability and uncertainty surrounding U.S. trade policy further complicate the decision-making process for businesses. Companies are wary of making significant investments in new manufacturing locations, only to see the trade landscape shift again. This hesitancy to disrupt established supply chains benefits China, as it allows them to retain their dominance in certain industries. The unintended consequences of the tariffs highlight the complexity of global trade and the difficulty in predicting the full impact of such policies. While the tariffs may have been implemented with the best of intentions, they have inadvertently created a situation where China, in some cases, emerges as the more appealing option for businesses seeking manufacturing partners. Section 5. Shifting Sands, Economic Forecasts and the Potential for Recession. The ongoing trade war and the recent tariff pause have sent ripples through the global economy, prompting economists and financial institutions to reassess their forecasts. Initially, there were widespread concerns that the tariffs could tip the global economy into a recession. Goldman Sachs, a leading investment bank, had even issued a recession prediction, citing the trade war as a significant contributing factor. However, following the announcement of the tariff pause, Goldman Sachs revised its forecast, withdrawing its recession prediction. The bank cited the easing of trade tensions as the primary reason for its revised outlook. While Goldman Sachs still predicts slow economic growth in the coming months, it no longer anticipates a full-blown recession. Despite the revised forecast, concerns about the economy linger. The trade war has created uncertainty and volatility in the markets, making it difficult for businesses to plan for the future. Consumer confidence has also taken a hit, as rising prices and economic uncertainty weigh on spending habits. The economic outlook remains fluid, with the potential for both growth and contraction. The outcome of the ongoing trade negotiations, the effectiveness of the tariff pause, and the response of central banks and governments around the world will all play a role in shaping the economic landscape in the months to come.